Welcome to Shared Lunch, a podcast from Sharesies with BusinessDesk. Now, before we get started, here's some important information. Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording. My name's Frances Cook. Today on the podcast, we talk passive income hacks with David McLeish, Head of Fixed Income at Fisher Funds. Kia ora, David.
Hi, Frances. Thanks for having me.
We have promised people passive income hacks, which means, I guess, the first question is, what actually is passive income and what is traditionally included when we use that term?
Yeah, that's right. Passive income actually a bit of a funny old term. It doesn't actually get used that much, but it mostly implies parking your money in an asset that requires little or no effort to maintain. That's a pretty broad kind of definition, and so I suspect your listeners will be thinking, well, that probably includes a pretty wide range of investments or things that I might be able to invest in, which would then generate this passive income, and they'd be right. But the term passive income, it typically relates to things like dividend paying shares would be one, even rental properties is another, and then even in its probably most basic form, things like term deposits or on-call cash still generates an income, but you're obviously not doing a lot to have to maintain that income. So theoretically, that could include even investment funds. A managed fund, for example, managed by us at Fisher Funds is another example, because you don't actively manage it. We would manage it on your behalf. So that could theoretically classify as passive income as well.
And of course, people talk a lot, put your money to work, make it earn money, things like this with the passive income. But when you are investing, how does investing generate that passive income?
I mean, it's quite straightforward in the sense that passive income can be generated by almost any investment. And as I just mentioned, there's quite a few quite different investments that all generate some form of income, but it is really important to recognize that not all passive income opportunities are the same. They've all got different risks associated with them. So just because they're generating some form of income without you having to do much to maintain that income, there is quite varying degrees of risk. The variability of that income stream is one of those risks. Some are very, very stable, some are not so. And then the other side of that would be, the potential change in the underlying value of that investment. Some investments don't change value at all, like a term deposit, whereas an investment in a managed fund, for example, does change in value on a day-to-day basis. So you definitely, as an investor in a passive income asset, you would definitely want to factor in your risk tolerance when you're trying to make these investment decisions.
Yeah, it's interesting, right? Because people often talk about income investing, which is a slightly more technical way, I guess, of talking about passive income. When you're looking at income investing as a strategy, what makes it different?
Well, mostly because a large proportion of your expected return will come from that income rather than the variability in the underlying asset itself, or the value of it. So, a good example would be clearly a term deposit. The variability of that investment is so little that all of the expected return comes from the income. So that's a really pure kind of passive income investment that you'd look for. So it really does depend on the breakdown of the expected return between the variability of the asset value and the income it generates.
A lot of people on this webinar will be Sharesies investors, and for many of them, I'm sure they'll have heard, companies that pay dividends are one way to invest when you're looking for income. How reliable is that? I mean, just because a company has paid a high dividend in the past, can you rely on it continuing to do so?
Yeah, that is a really great question, and one that actually probably gets misunderstood quite a bit is that you're right, dividend paying companies are usually more mature, more stable businesses that have got very reliable earning streams, which they can then use some of those earnings to again pay a really reliable dividend to their shareholders. So that's the norm. But it is really important to recognize that as an investor in an equity, you are a shareholder in that business, and that the board or executive team can decide to change that dividend at any time without really much notice. And so if say for example, the financial standing or the earning stream of that company was to change and in particular to deteriorate, there would be good reason for that company to change its dividend paying policy and therefore pay out less income. So that's a good example of how variable income streams can be, especially when you're investing in shares.
Yeah, and you mentioned something there to look for is, how mature a company is, which is a really good place to start when you're looking for those dividends, those established companies that maybe aren't trying to reinvest so much of their profits back into growth. They're established already. They can give back some of their money. That's one thing to look for. I mean, what else are you looking for when you're looking for a company that could pay high dividends? Are there particular industries? Are there particular results or forecasts that you should be checking out?
Yeah, certainly industry is a really good one in the sense that, again, as I mentioned, the reliability of their earnings is the primary driver for their ability to continue to pay that dividend stream to you as an income investor. So investing in companies that are in industries that are more stable, less cyclical is a really good start. Good examples of kind of flagship, I guess, or kind of bellwether dividend paying stocks around the world would be names like Coca-Cola, for example. Colgate-Palmolive would be another one. And those are in consumer areas, but in kind of non-cyclical consumer parts of the market whereby their income streams, again, are very, very stable. So investing, if you wanted to really rely on that income stream, investing in industries and therefore companies that do have those regular earning trajectories is really important.
Now we're going to move to actually what I think is probably the meat of this conversation, because there is this whole section of investing called fixed income or the bond markets. So that often is used to provide investors with a set income. Now, bonds, we don't always talk about them as much as shares. They don't always give the same razzle dazzle. So could you give a bit of an overview, a bit of in a nutshell?
Yep, absolutely. So you're exactly right. I think it's probably, even though the fixed income market is actually the largest financial market in the world by quite some margin, so multiple times bigger than the global share markets, it is probably a little bit less understood, and maybe its complexity as an asset class is one of those reasons. To give it kind of the most, in a nutshell, basic explanation, bond is the most common form of fixed interest asset, and in its most basic form, it is essentially a loan, and that is a loan offered to one borrower via a number of potential lenders, and those lenders are called bondholders. So you can essentially subscribe to a bond, and that money goes to that borrower under a standard set of terms. So again, all those lenders all pull together and lend that money to one borrower with a fixed term usually and a fixed interest rate. Now, I suppose that it's important to recognise actually just there as well is that those borrowers can be really diverse in nature. So it could be a government, for example, a local government authority, but it could also be just a company like Coca-Cola or Colgate-Palmolive that I mentioned earlier. They borrow as well in the public fixed interest markets. It could even be a bank. There really is anyone that any borrower could come to the bond market to be able to to be able to borrow in that form. So that's essentially why, given, as you can think about it, there's a fairly large and diverse range of borrowers and lenders at any one time all around the world. That's essentially why the bond market really is just so large.
Yes, exactly. It is huge. I mean, it's quite interesting with bonds because they are often seen as on the risk scale as less risky than shares, but more risky than something like a term deposit. But it depends also somewhat on who the bond is with. So someone like the New Zealand government, they've got a really high credit rating. That would be seen as a fairly safe investment. They're probably going to pay you back. A different government, I don't want to name names or pick on anyone, but there are other governments around the world seen as less stable. They might be seen as higher risk, right? So how do what sort of return can you be expecting from bonds generally? And then how do you vet them in terms of their risk?
Yep, that is exactly the right point, in the sense that there is quite different credit quality of different borrowers around the world. So from kind of developed government borrowings, which again will attract the lowest return, but are obviously the safest, all the way through to, as you mentioned, some less stable governments, for example, but all the way out into companies that have got a lot of debt, or maybe operating in very cyclical parts of the economy. They will have to pay a higher level of interest to attract that money. You touched on another really important point, and the difference between, say, a bond, a fixed interest asset, and a dividend paying company, for example. There's lots of differences between the two, but the two most prominent would be that a bond is essentially a financial commitment or liability of that company. So they are financially obliged to be able to meet that obligation. And again, as I mentioned earlier, from a dividend paying share, there is no actual financial obligation to continue to pay those dividends. So that's a really important one. And then the second point would be that if things don't quite go according to plan in your investing and the investment decisions that you make, and if you had lent monies to a company through a bond, the good news is that even if they can't meet those financial obligations, that you typically will sit right at the very top of the queue if there is any money to come out of that business. And in fact, in many cases, you have to be repaid as a bondholder entirely before shareholders and dividend-paying stocks would even get 1 cent. So there is a real big difference between the variability of the returns of those two things and the comfort that you might get from that income stream.
Yes. I think a really good way for people who are new to bonds to think about it, right, is it's most of us have taken out loans of one form or another at various points in our life. And when you have a credit card or a mortgage or whatever, you have agreed, I'm going to pay you back this monthly installment and you get this much interest back, and it is not entirely the same system, but it's a very similar system for bonds, right? It is an agreed amount, you get an agreed return, and it comes through, and that's why they refer to it as fixed income. You know far more what you're getting back at a set pace.
That's exactly right. And the good news, I guess, right now is that because interest rates are high, that level of income that you can achieve from a fixed income asset like a bond is actually very high. Certainly, historically speaking, we're kind of back to the same levels of interest that you can get on a more safer fixed interest asset that you could have got back in sort of 2008, 2009. And those sorts of levels now mean that you can lend to a good investment grade quality company and achieve an income level of anywhere between 5 and 10% now. So it really does look like quite an attractive time to be investing in some of these safer products.
Yes. Okay, let's talk interest rates, because I think it's so interesting how that impacts investing strategies in general. And with interest rates cranking around the world right now, it's really interesting how it is impacting debt, fixed income, bond markets. It's fascinating. So there is an impact on bonds, right? But there's a different impact on how it impacts the value of existing bonds that were already out there that people might be buying through regular funds already existing on the market versus new ones being issued, right? That there's two different impacts.
Yeah, that's a great one. And this is where it starts to become a little bit more complex. So hopefully I'll be able to explain it in a relatively straightforward way, is that as interest rates rise, the value of all of those bonds that are outstanding in the market falls. And the reason that is the case is because all the new bonds coming to the market, as you mentioned, have a higher interest rate. So let's just use a really simple example. If you had a bond that paid you 3% interest per annum, and then all of a sudden interest rate overnight went to 5%, and all of the new bonds being issued that very next day were all coming at 5%, well, no one would really want your 3% bond, right? So the price of it has to fall to be able to compensate for that lower income that asset will be generating compared to the now going rate. So that's a really big reason why fixed income returns in the last couple of years have been actually quite negative, is because all that stock of fixed income assets around the world that had lower interest rates associated with them have now had to be repriced lower, take into consideration the now higher interest rate environment. But then the silver lining is, again, back to your point, fixed interest is it does provide a fixed level of return. And so now looking forward at these higher levels of interest, you can actually achieve really good levels of income on this asset class. That's largely because the price of those assets has fallen for the best part of 2 years.
And it has been quite, we've seen some weird things happening in the financial markets over the last couple of years because everyone's been thrown for a bit of a loop. I don't know if anyone's noticed, it's been weird times recently. But, in the past, bonds were seen as a hedge, a way to balance out a bit of safety against things like a share price downturn, because typically, prices went up, bonds would go down, or if bonds went up, shares might be going down. It all balanced out a bit. Now that hasn't been so much the case over the last couple of years, particularly, maybe some people who have a balanced or conservative KiwiSaver have been a bit upset with how things have gone. What's changed there?
Yeah, you're exactly right. And high inflation is what's changed. We've spent 30 years in a slowly falling inflationary environment. So back in the 1980s was kind of the last big peak, late 1980s, in inflation. And ever since, it's been on a downward trajectory until about 2 years ago, 18 months ago, when it really bottomed out. And thanks to the pandemic and a number of other factors, we've seen inflation really rip higher on the back of that. Why is that important? Well, when inflation is as high as it is right now, that actually just creates instability across financial markets. And that's largely because central banks, like our own Reserve Bank of New Zealand, is rapidly raising interest rates like we've just mentioned. And the reason they're raising interest rates is to try and get inflation down. It's to try and slow down the economy. But because they're having to raise rates so quickly in such a short space of time, that is creating stability. That is creating not only angst around inflation and will they be able to get on top of this inflationary impulse, but it's also creating angst for, say, the share market around the impact that might have on the economy through slowing the economic activity down by implementing higher interest rates in the economy. So what you've got is this really quite unique situation that we haven't really seen until since the 1970s, when we had a stagflationary environment, which basically means that inflation just gets very, very high and almost out of control at the same time as economic activity is falling away and there are concerns around a recession. So you've got this quite unique scenario where both of the major asset classes in a portfolio, fixed income and equities, are both going down at the same time. That's very unique.
Now, I mentioned this a little bit at the beginning of our chat. I'd like to get into it a bit more. there can sometimes be a perception of income investing versus growth investing. So income investing is often seen as more conservative and seen as being for more when you're approaching retirement, you want that income, you want to start drawing down on your wealth, and it means giving up some of the growth that you might have been investing into those high growth superstar companies that might increase in value but aren't necessarily giving you cold hard cash back right now. So do you think, that income versus growth is an accurate perception? And is there different life stages that each tactic is useful for?
Very much so. As we've really kind of discussed quite a bit already today, is that fixed interest or bonds can play an important role in a diversified portfolio. And the reason that they can do that is typically they are more defensive. They're less volatile, and they have at regular periods of time throughout history created that offsetting factor where they typically go up in value at the time when equities are going down and vice versa. So that is quite often the economic environment. So that can be fixed income can be a real diversifier when you layer that into a portfolio alongside, say, a growth-oriented asset class like shares or property, for example. But that defensiveness means that bonds typically, as I've mentioned, are lower returning over time, which does make them a little bit less sexy. And I get that, and we get that a lot from our younger investors. And it's also, what I'd also say is that fixed income is less appropriate for investors who do have a longer time frame that they're investing for. So younger people that are investing for retirement, for example, should be able to accept more volatile short-term returns because they don't need that money right now, with the chance of achieving a far higher return from, say, growth assets like shares or property over longer periods of time. So it's been able to stomach that volatility for the longer term gains that you can get from growth assets. Fixed income is more reliable as a return driver, and therefore more suited to an older clientele.
Interesting. Do you think it's one of those things where younger people should have a small proportion in terms of fixed income, or really ignore it entirely? What do you obviously we're speaking generally, this is not financial advice, but in general terms, if someone's got that longer time horizon, should they have even a small amount?
It really does depend, again, largely on people's own risk appetites. There is a real kind of personal aspect to this, in the sense that as an investor, regardless of your investing time horizon, sometimes the volatility of a certain asset class like shares just might be too great for you to live a comfortable life, and that you end up kind of constantly checking your balance, for example, would be a good kind of telltale sign of that maybe your risk tolerance isn't suited to your current asset mix in your investment portfolio. So I think there's a real personal element to that, but certainly without a doubt, the longer the time frame that you're investing for, the higher the proportion of growth assets you should have. And if you are in your 20s and 30s, that is a long time until retirement, and would justify a very low weighting to income assets like fixed interest.
Interesting. Now, I would like to remind people we've got some great questions coming through already on the Ask a Question button. So we're coming to the end of my section of asking questions. If you have a question, please do drop it in the Ask a Question section. And also, even if you don't have a question, get in there and upvote the ones that you are most interested in, so I know which ones to ask first, because we can't always ask all of them. We do sometimes run out of time, and I want to make sure that your burning questions are the ones we ask first. But before we do that, a very important question. If someone is looking at this and they're thinking, I want to have my investments set up so that I can go and live on a yacht 6 months of the year, what sort of money do you need to have invested into things like dividend stocks, fixed income? What sort of figures are we talking before it is reasonable to expect a livable income from your investments?
That's a really interesting question. One I haven't actually been posed before. My initial thought would be a boatload of money you would be required to
Oh,
supplement
that's cheating.
your income. Okay, so maybe let's just do some really basic maths. So average individual in New Zealand, I think, earns about $60,000, and that's before tax. So call that 50 grand after tax. And then let's use two examples in New Zealand. Again, the New Zealand Stock Exchange, the dividend yield on just all of the companies that make up the New Zealand Stock Exchange is about 3%. And so to achieve that, half of 50 grand, because you said 6 months of sitting on a boat, to achieve 25 grand's worth of income on a 3% yielding investment, you would need about $1.6 million. So that is a boatload, isn't it? Right? There's actually now that's probably a little bit unfair on the New Zealand Stock Exchange because it doesn't have very high dividend paying stocks here in New Zealand, and there are some higher dividend paying stocks overseas that you could select. But the numbers are that. You asked the question around how that relates to, say, fixed interest assets. Our income fund here at Fisher Funds is generating around about a 7.5% level of income per annum right now, because again of how cheap bonds have got recently. So that's well over double that dividend yield on the New Zealand Debt Exchange. So therefore, say about half of that 1.6. So it's probably like $750,000, so 750K that you could have invested in, say, an income fund that's generating 7.5% of income, and that would supplement your half a year on a boat.
I love it for a question that got thrown at you last minute, and also very impressive mental maths. My mum's a maths teacher, and she would love you right now.
Yeah, well, I suppose it comes with the territory a little bit. Investing in fixed income assets, you have to probably have done okay at maths.
Very good. All right. Well, let's jump into some of these questions that we're getting from the audience, because they are fantastic. Now, I'm going to start with the one that has the most upvotes. I'm not sure if it's totally your area of expertise, but we'll see what you think of it. So it says, are there other passive income streams outside of places like Sharesies? I've seen so many Shopify, Amazon, creating online courses. What's your opinion on those types of things?
So just to be clear, you think, Francis, that question's related to just the different types of income assets that you could invest in? Is that what I should be taking from that question?
I think it's more that it's the type of, you see a lot of sort of passive income hacks around to be honest, I mostly see them places like YouTube and TikTok that say, you can create these businesses and then create passive income. And I don't know, my personal opinion is a lot of these can be entirely overblown, and maybe sort of the investments that we've been talking about are a little more reliable, but I'd love to know your thoughts.
Yeah, no, thank you for that. Thanks for clarifying that. Yeah, I'd agree with that statement of yours, Francis, in the sense that these kind of not necessarily get rich, but put together a reliable stream of income that can almost displace having to go out and earn it, really are kind of a dime a dozen, and typically don't kind of meet the rigor of a good investment process. So I'd say the same thing, that when you start to look under the hood of these things, the reliability in particular, you might be able to achieve some income for some period of time, but the reliability of that probably isn't what you would want it to be.
Yeah. I see a lot of these things being advertised around, and it's such a shame because I would love for them to work. I would not be here if that was the case. But that's why we have investments, and these things have been proven over a long period of time, and they do work. Okay, great question here from David. What stocks or positions does Fisher Funds invest in with regards to both their growth and passive income funds? In the future, could clients have more transparency about what their KiwiSaver invested in? So your thoughts? There's a few sections of that question there.
There is. Great question, David. And so the first question, I think, was really around what are the types of assets that we invest in, say, income or non-income generating parts of our portfolios. And it's actually pretty wide. So from the income generating side of things, we do invest in government bonds, and we invest all the way through into company issued bonds. And that's all around the world. And they will be in a number of different industries. They will be for various tenors. So some of them will be lending that money to that borrower for a very short period of time, sometimes 3 to 6 months, and sometimes all the way out to 15, 20 years. Depending on the quality of that borrower and the return that we think we are from that type of investment. So very diverse when it comes to income generating assets. From a growth perspective or income generating, we have more concentrated portfolios. And Francis, as you mentioned earlier, a kind of particular area that we invest in the share market is in growth-oriented companies. So companies that really don't pay any income to their investors. They take their earnings and reinvest back into their business to grow the earnings stream. And we think backing those companies that can and know their businesses better than anyone and know the opportunities ahead of them, if we back those right companies to make those right investment decisions, we can really compound those earnings rather than take those earnings away from the company. So much more growth oriented. And then to answer the second part of the question was around transparency, I think, of our portfolios. And to think that we're very transparent in that regard, we produce a holdings list on our website for all of our funds, and those sometimes are only like a top 10 or top 20, but again, we can provide and do often provide at least the names of the types of companies we're investing in across the whole spectrum. So that should all be there on our website. If it's not, and David would like more information, please get in touch with me directly and we'll make sure that he gets a full list of all of the investments we have in any portfolio.
Yeah, I do think that's the key. Is often I have a lot of people get in touch with me with questions about their KiwiSaver, and I'll often say, have you got in touch with the company first of all? Because there is often a requirement to be open about these things, and maybe the most of it will be on the website and you can get more of it by requesting. So a quick email or phone call can be a great one there. This question from Tim has a stack of votes, so definitely got to get into that one. Does it make sense to buy bonds immediately before you think interest rates will go down? Ooh, your thoughts?
That is an awesome question. I really like that one. And the reason I like that one is because of what we went back to is that right now the level of income that these assets are throwing off is really quite attractive, anywhere, as I said, between kind of 5 and 10%. So on the face of it, that looks fantastic. But again, if interest rates continue to rise, as we mentioned, the value of those assets may actually start to fall and offset some of that income that you can generate, meaning that your return is going to be lower. And if interest rates keep rising really rapidly, in a quite extreme circumstance, that mark-to-market loss or reduction in value of our assets could even swamp that income and therefore generate a total negative return. So that's why it's such a great question, and that's exactly what's been happening recently. So to answer the question, the first point is that the question specifically was around regardless, I guess, if interest rates continue to rise, I think that fixed interest offers a really good opportunity right now, because again, we've got to that level of income that will offset even some quite steep continued rises in interest rates from here. So what I'm saying is you don't have to pick the bottom in the bond market and the top in interest rates. I think you can safely start to deploy capital into this asset class, and you might not pick exactly the right time to invest, but I think returns are going to be pretty attractive from here on out for the cycle. The other point I would make, though, is that, again, the future is obviously uncertain, and interest rates have risen a lot very recently. And if inflation really doesn't start to come down anytime soon, then you can expect central banks like our own Reserve Bank of New Zealand to keep raising interest rates, which will put downward pressure on the value of bonds for a little while longer.
Okay, we are getting excellent questions through, guys. Thank you so much for sending these through. Another one with a lot of upvotes here from Michael. Can you liquidate a bond at any time, or are they always fixed?
Yes, you can, is the short answer, and that's in, call it 95% of the circumstances. So there's always exceptions to that rule, whereby some bonds are very illiquid and can't be just easily sold into the market, sold to another buyer. But there is a very active and liquid market in a very large majority of the bond investments or fixed interest investments that Fisher funds on behalf of their clients. So liquidity is very good. It does go again with financial stresses, and again there are exceptions to the rule, but yes, you can, as a rule, liquidate your assets when you want to.
And this one from Jay, this might be one of those depends questions, but I will leave you to answer that, of course. What ratio of income to capital growth investments would you recommend? How does this ratio change and why?
Yeah, it does depend. You're exactly right, Francis. And that depends first and foremost on your risk tolerance. Again, because they are different types of risk and variabilities of returns. So mixing the two together and those certain quantities will be very much dependent on how much risk you want to take and how much risk you want to take from a lifestyle perspective, but also from, as I say, how long you might be wanting to be invested for, or when you might need that those funds back are very important. But I would, just to put some numbers around it again, typically there's a 60-40 portfolio has been one that has been kind of touted as a good starting point for a balanced strategy, and that is 60% equities, 40% fixed income is a balanced strategy typically. Now that may vary 10% kind of either side of that at any one time, but that's been largely what portfolios have been constructed off as point for risk tolerances for really the best part of 50 years now. And so that's a great starting point, I think, for then you to want to calibrate, are you more conservative or more risk inclined from there?
Yes, yeah, exactly. And I think this one's somewhat related. This question from Bryce. If you're looking at a long-term passive income investment strategy, what sort of time in years would this look like? 20 plus years, or can you do it quicker with more initial investment?
Yeah, you can actually do it a lot quicker in the sense that you can put that money to work right now. So whatever of money that you wanted, you could put it into obviously a bond fund, or you could invest directly in bonds yourself, or any other income generating asset for that matter. It doesn't have to be obviously fixed income. And the time frame is really up to you, and to many respects is, again, and just taking it back to the fixed income example, is that because those assets are relatively defensive and are therefore less volatile, they do lend themselves to slightly shorter time horizons for your investment period, be it 2 to 3 years, whereas with, say, equity investments or share investments, even if they are high dividend paying defensive companies, you would still probably want to be invested for 5+ years in many cases, to ensure that you do take get all the benefits and don't just take all of the volatility that is associated with that asset class. So short answer is you can really kind of take as you can invest for as long or as short as you want in many cases.
This is probably the last one we have time for. We shall see. But another great one from Tim. What are the pros and cons of investing in bonds versus term deposits?
Oh yeah, that is a really good one. And it's one that's actually really dear to my heart at the moment, because as you might imagine, with interest rates going up like they have, so have term deposit rates, and that has got a lot of people quite interested again in the class and kind of saying, well, hey, again, from a real passive perspective, I can just park my money in the bank and it will tick away with a really nice kind of mid-single digit type of income, and I won't have any variability in that in the value of my asset, and I can just go on with the rest of my life. And I get that, and that might be really appropriate for certain kinds of investors. But what I would say is that banks are very disinterested in your deposits right now. They are flush with cash, and they are paying those sort of somewhere between, let's say, midpoint's probably about 4.5% on a 1-year term deposit right now. That is, you've got to bear in mind that we're probably going to have an official rate of over 4% in a couple of weeks' time, in a week's time. And so that's not exactly a large premium that the bank is paying to have your money for a whole year without you being able to get access to it. That really is that's the lowest additional premium that banks have almost ever paid in history. So they are really disinterested in your money. Whereas the fixed income market, again, which you would expect to be very closely linked to term deposit rates, has actually broken away. And interest rates on fixed income assets, like I just mentioned, our income fund up at like 7.5%, you would normally expect those two numbers a lot closer together. So putting money in the bank right now is not a particularly attractive proposition, in my opinion.
It's so interesting, isn't it? So many of the usual rules are a little upside down at the moment. Well, thank you very much for tuning in, everyone, and your fantastic questions. And a big thank you to David for joining us and answering them all. Really appreciate your time and your insights.
My pleasure. Thanks for having me.
Thanks for listening, and a big thanks to David for joining us. Now, if you're not following the podcast, you can on Apple or Spotify or wherever you get your podcasts. Leave us a rating and a comment with who and what you'd like to hear about. Why not check out Shared Lunch Live as a Thursday lunchtime webinar via Crowdcast, or watch it anytime on the Sharesies YouTube channel. Grab the link in the description of this podcast. Next week on Shared Lunch, we speak with Infratil CEO Jason Boys. Register for that discussion on Crowdcast so you can hear conversations play out in real time and get your questions answered on air. The link is in our podcast description. Until next time, ka kite.